Welcome to the SwineTime podcast here at Pipestone. I'm your host, Spencer Wayne. I'm one of the staff veterinarians here at Pipestone. So I go out and see pigs for clients during the week, but then they let me do something really fun, which is to host this podcast. And my guest today is Damon Vander Maten. And I should also say I'm one of the partners in Pipestone Holdings, and I've got the honor of saying, hey, one of my now current new partners, Damon Vander Maten. So, Damon, why don't you take it from there, introduce yourself, and say what you do and why you're here to talk about it, or what you're here to talk about today.
Yeah, absolutely. I am Damon Vander Maten. I grew up in southwest Minnesota, small family farm, hogs, cattle, row crops. Grew up loving pigs, loving working with pigs. Went to college in northwest Iowa at Dordt. Started working at Pipestone right away. Fell in love with Pipestone immediately. My grandpa was a shareholder in a Pipestone farm, so I knew about Pipestone, and that's really what led to the pursuit of Pipestone for me. And I've got a strong passion for the farmers today, and I want to be able to be as helpful as I can. And one of the ways that I can do that, which is what I do today, is by leading our FarmBooks department. So FarmBooks, we go out to producers, help them with their financials, help create real accrual financials that they can help use to manage their family farm.
Okay. So you made me think of a few questions. One is, what hometown?
Yeah. So
Edgerton or Leota?
I claim Leota as the hometown, but very close to Edgerton as well.
Okay. So Leota, yep. And your dad was a shareholder in which unit?
In Whitetail Run, Great Plains Family Farms.
Yep. I thought that probably was it. I wasn't the vet for Whitetail ever, but I've been there a few times.
Yep.
When it was one of our farms.
Yep.
Okay. And last question, you went to Dordt. You studied accounting major, or what was your major?
Yeah. So my major was in finance, minored in economics. Naturally, when I came to Pipestone, they got me into accounting right away, which ended up being very good for me. Learned more about accounting, and now I'm able to utilize that accounting knowledge with the finance to be able to put together this full package.
Okay, and you got your own hog barns and your own hogs too, right?
Yep. I've got my own hog barn. I still farm with my dad. Still do that on the side outside of Pipestone. So I still help manage our pig flow and pig business there.
Okay, why are you here, and what do you want to talk about?
Yeah, so today I am here to talk a little bit about risk management, and then also touch a little bit on the financials and how that plays into risk management decisions as well.
Okay, so for the sake of myself, because I don't know some terms sometimes, cover the basics, just some real basics of risk management means this, and here's some basic vocabulary that you'll be dealing with if you're engaging in risk management.
Yeah. So from a very high level, I know a lot of the producers out there use risk management already, so they're maybe familiar with these terms, but a very common one is futures. So you go to the board, the CME board, you can lock in the revenue for your pigs, you can lock in your feed inputs, corn and soybean meal, and in order to do that, you have to set up a hedge account, usually with a local brokerage firm, and once you place those trades, that's locked in. As the board and market moves, you may gain margin if the market goes down, if you sold a future, or if the market goes up, you might lose money on that trade. But the whole point of risk management is really to take out those valleys, the lows. It's going to take out the peaks naturally as well, but help create a steady income for you so you don't have to worry about those deep lows.
Yeah. So basically you say 5 months in the future. If I sell these contracts, that effectively is my sell price in the future because I can offset it with actual sales and the market goes up and down, and you're made whole with what you strike at out there as your future sale price, which means I got my inputs locked in, I've got my pigs sales locked in. I can calculate my profit or loss at that point. And that's what you're saying, just lock in what you can live with, what you want to have, but that's that flat number versus what's it going to be? And you're like holding your breath until the last minute.
Yep. Yeah, there's a lot of details that go into it. There's things like basis, which I'm not going to discuss today, but producers are very familiar with. Basis definitely affects that as well. But short story, you can go out, lock in that revenue, and if the market goes up, you'll get paid more for the pig. You'll lose money on risk management. If the market goes down, you'll make less money on selling that pig, and you'll make it up in your risk management account. So you end up at that strike price that you locked in.
Yeah. So I'm thinking of why you'd want to do that, because you said I take out the peaks and valleys and I get to a flat, predictable profit or loss. But my money situation gets really predictable the more you lock it in.
Yep.
Why would you do that versus not doing it at all? I mean, other than you don't like peaks and valleys, why would you do that? Why would you need to do that?
Yeah, and that's part of the reason that I wanted to do this podcast was I work on the FarmBooks team. I help lead the FarmBooks team. So we see a lot of different producers. We see a lot of different risk management strategies, all the way from they're locking almost all of their inputs and revenue in to the other extreme of they're not locking anything in at all. And generally what drives those different decisions or strategies is producer A might have a lot of equity, very little debt. They can afford to take on those highs and lows in the markets versus producer B, who might be in a tighter cash flow position, whether that's from historical losses or whether that's from just being a new farmer. They can't afford to lose, and they can't afford those deep, deep lows. Mm-hmm. So they want to take advantage of this risk management, have a more consistent income that they can go to their lender with and build confidence that they're in it for the long run.
Yeah. So I'm thinking of a client that I work with, and there's farmer A and B. Farmer A was the older generation, and he had deep pockets. And so he never locked anything in. He said, why? I just ride through, you'll get the average. Farmer B bought it from him, but that Farmer B has no land base. Farmer B really scraped it together to buy the farm and doesn't have nearly the risk tolerance. And when I was talking to Farmer B, about this, exactly, the first guy, Farmer A, never did that. Well, he has more ability to ride through storms than you currently do. And so how do you get to the point of knowing how much risk management you have to do, I guess, is a natural question.
Yep, that's a great lead into what I would call risk tolerance. So everybody should try to understand what their risk tolerance is and measure what kind of risk am I willing to take on or can I take on. So the producer A, the older generation possibly, they've got a higher risk tolerance. They're willing to take on more risk. Producer B maybe bought a new farm, doesn't have land backing them. They've maybe got a way lower risk tolerance. But either way you look at it, with that lower risk tolerance, they can't afford to take on those lows. So they gotta use risk management, take out the lows, stay disciplined, which is going to give them an opportunity for the long run.
Okay. So what's the next question regarding this? Where do you go next and how you think of it? Is it still at the level of mental, emotional, how you guide yourself, or are we in the technical points at this spot?
Yeah. I would say now kind of leads into my discipline approach, where discipline within risk management will lead to freedom. Okay. So by being super disciplined, you're going to allow yourself to free your mental space with not having to worry day to day about what the market's doing. If the market ran up, if the market's going down, you want to be able to be free, do your work, focus on the things that you're supposed to be executing that day and not worrying as much about, what are the markets doing? I better check my phone quick. If you're super disciplined, you got a hedge strategy policy in place with your brokerage, you should be able to go to that person, that trusted advisor or brokerage. You should be able to put trades out there to say, if the market gets to this point, or if I get to the point where profitability shows $15 per pig, I want to lock those in. Okay.
So we don't lock those in. We're not a person that takes positions on the board, but there's companies, you just referred to them, and I could think of a few, but you just find them in your farming community. You'd know those people.
Yep.
Locally here, we got Pat Von Tersch and ProAg. There's CIH.
Yep.
There's others, I'm sure, but those would be tools available to you to do that. And then there's a cost to doing it. And we talked about this a little earlier.
Yep.
There's a fee for these transactions, but in the big scheme of things, it's not free, but it's minimal. There's no reason not to do them based on that cost.
Correct.
That'd be
Correct.
a fair thing to say.
Yep. You're going to have transaction costs with the futures or options that you place, and you're going to have money that's tied up by placing those trades, and you're going to have interest on those dollars. But in the grand scheme of things, taking out that low for that minimal cost, not even comparable. So it's kind of like an insurance. It's another form of insurance. You're doing risk management. You're managing a risk. You're taking out that low for a small cost. And I could even say from my experience with the FarmBooks data set that risk management has proven to even add value if done the right way.
How so? What's a good example of that?
Yep. So there's lots of different ways that you can manage risk. If you have a trusted advisor, somebody that's very, very familiar with the markets, they might study the historical trends in the markets. They might be able to tell you when is a good or a bad time to place certain trades, which is going to allow you to take advantage of the best risk management policies instead of just going out and locking in these prices right where they are today.
Okay. So I want to pull back to a little bit of farmers' emotions and the perspective you get. And so I'm thinking of my good friend John Lehman would say, when the market's up, it's always up. When it's down, it's always down. And so you get locked into thinking. You had one earlier, you were talking about high prices, fix high prices, because people get exuberant in their activities and they oversupply and it cycles back and forth.
Yep.
And so we're going into a period of profit. We're in it right now, and we'll be in it for a while yet, it looks like. How do you emotionally handle that? You got the desire to potentially overextend yourself during this period to spend money that you're making now versus saving it or being more judicious with it. What's a good bit of advice you would have for farmers currently that are making money and how they approach the next 2 to 3 years?
Yeah, absolutely. And some of that comes back to the discipline again, in saying that history typically repeats itself. Like you said, the last 2.5 years weren't great. Experienced some losses in general in the pig industry. Looking forward to 2025 now, looks like there's really good opportunity. We're hopeful that 2026 will show the same thing. But like you said, high prices cure high prices and low prices cure low prices. So just like low prices kind of cured themselves over the last 2.5 years, high prices will eventually cure themselves as well. Mm-hmm. So something that I've tried to tell the producers that I work with is, just because you've gotten burned with risk management once, let's say I put hedges on for the summer months, we got to those summer months, the markets ran, I lost money on those hedges. I'm mad at myself. I don't want to do that again. I don't want to lose money on risk management. So going into Q4, I'm not going to place any more futures, options. I'm going to leave it open. You get into Q4 and the market drops, tails off, spins down. Mm-hmm. Now all of a sudden you missed out on the opportunity again. Mm-hmm. So by being super disciplined, just because you lost money in those summer months, stay disciplined, keep using your strategy and your policy moving forward, and you won't get burned again.
Yeah.
Because hopping in and out of the risk management game is not good.
That's like a tale as old as time, because I can think of several farmers that they were well hedged and didn't capture the profits and said, I'm not doing that anymore, and then just pull it off in time to lose a ton being unprotected.
Yep.
That's like, it happens so often. They get emotionally activated, not going to do this again.
Yep.
And then boom, they lose.
Yep. Emotion plays a big, big part of it.
Right. Okay. So that naturally leads us into, what tools do you need to do risk management well? What kind of instruments do you have to have at your disposal? And I'm kind of thinking the level of sophistication in accounting, it could be a shoebox full of receipts, and the other level is you got a on-staff accountant. Can you take us through just the spectrum of how sophisticated people are and what you need to do risk management well?
Absolutely. Yeah. Nope. That's a good intro into, it plays a little bit into the producer A and B scenario, where if they've got a lot of equity, they're willing to take the risk, they've got a higher risk tolerance, their bookkeeping might, not saying it is, but it might be less. It might be cash income QuickBooks software versus producer B, who doesn't have equity to lose, is tighter on cash flow. They should have, for sure, more detailed accrual financial statements. So to your point, you might have the guy keeping receipts in shoeboxes, writing things down on a notepad, basically hand calculating cash income for the year and cash expenses. Next level, you might have somebody in QuickBooks doing the accounting themselves, getting that cash income and expense, but at least you've got it in a software where you've got it categorized by expenses and income. So
if you're the banker, I'm thinking the banker is a shadowy figure in the background supporting your activities, shadowy in a good way maybe.
Yep.
He's going to need more than a shoebox and a notepad if he's funding your activities, not knowing quite what's going on. So the level of sophistication relates somewhat to what your lender is going to want. Correct?
Absolutely. And that's what ties in a little bit to the cash flow. If you're a producer that's a little bit tighter on cash flow, that lender is going to require more of you from a financial reporting standpoint. Mm-hmm. So, and even without that, even if the financial lender isn't requiring that, it still shows a lot to the lender if you're going to the lender with that, even though you don't need it. That shows the lender that you know what you're doing, you're on top of it.
Okay, reasons to do a more sophisticated job with your accounting would be your lender, but also for yourself. Because one thing we haven't talked is knowing what's my cost of production, and you might not have a good idea. I've run into a lot of farmers that they don't know. They just know they sell pigs and they buy feed and they rent barns, and at the end they made money or they didn't, but without a lot of detail.
Absolutely. It's really hard from a cash income, cash in, cash out standpoint to calculate your cost of production, because you might have ebbs and flows in your inventory, pigs on feed. You might have ebbs and flows in your crop inputs, and you can create an accrual income statement using inventory changes, but it's not going to give you the detail that you need. So from a more sophisticated standpoint, how I like to think about it is with risk management. Let's say we go out and we lock in what we think is a $15 profit per head. Well, once we do that, if we're just doing cash income, cash expenses, how are we ever going to verify that we actually made $15 a head when we did that? So our accrual financials, we're lining up the timing of all the expenses that you've put into these pigs. When you sell that pig, we're offsetting the revenue with those expenses, and we're able to calculate the margin or the profit that you made per pig. Mm-hmm. From there, we can add or subtract the risk management activity.
That's a whole separate line item to know.
It's a whole separate line item, yep. But from there, we can calculate we made $10 of profit per head, or we made $15 of profit per head. Because I see it a lot. They lock in a $15 profit per head, or what they think is a $15 profit per head, ends up being $5, or maybe it's $0. What in the world? I thought I locked in a 15. Well, without detailed financial statements, how are you ever going to know?
Yeah. Hey, this is for dummies like me. Without doing accounting 101, simple explanation of accrual versus cash accounting when you think about money coming in or out of your farm operation.
Yep.
What is the basic description of that?
Yep. So I'm going to use pigs, kind of like I did a little bit ago, but cash is just going to be the cash that came into the bank account that month and the cash that went out. So if you think about the cash that went out, you're going to be paying for feed for pigs that are maybe 10 pounds, 15 pounds. You're going to be paying for animal health that are for the pigs still in the barns. You're going to be paying for rent for pigs that are still growing. So that cash expense out the door might not line up or offset, it won't, with the revenue that you collected that month. So the pigs that you sold that month, especially if your flow isn't perfectly even month to month, those aren't going to correlate with each other. Accrual financials takes that feed, puts it into the groups that actually received it, builds up those costs in those pig groups, and when you sell a pig out of that group, that's when those expenses show up on the income statement. So you can see the $180 revenue offset by the $170 for the cost of production.
Okay, so levels of sophistication, being in a spot where you're doing accrual accounting for your production would be important, just so you knew, like, yes, here's how I actually did versus a big lumpy number of dollars going in and out.
For sure. From an accrual standpoint, it goes back to the lender. It's going to build confidence with the lender. Risk management is just another reason to do it, so you can help measure your risk management performance. And you'll be able to see if the strategy or the policy that you've got in place or that has been in place over the last couple of years, if it's working, or if you need to think about making a change. So accrual financials will help you with that. And then lastly, and most importantly, it gives the managers and the owners of that operation financial information that they can actually go and implement changes and make decisions from.
Right. So you've described levels of sophistication. You got some tools. Some farmers might be sitting out there and what's the next, if I got to get better at this, what's the next step? And so what would that be? Because I know at one level is just start saving receipts if you weren't doing that, or they could call you up and you could do a very professional job at a lot of advice and guidance on it. But what's the spectrum of trying to get better? What does that look like?
Yeah. No, I appreciate that, Spencer. So I'm going to use the producer that's maybe just doing everything in a cash income, cash expense in their own accounting software today. I'd say at the very least, you should be working with somebody to try and put together an accrual financial. Even if it's once a year, that will at least be helpful, but I would highly suggest doing it throughout the year. But converting that cash to accrual financial, it's not going to be perfect. It's not going to have the detail versus if you were doing accrual for the whole year, but at least it's going to get to a starting point that you can start to use to make decisions.
Okay. What is that? Who is that person? Is that an accountant in town? Is that a farm advisor? What is that?
Yeah.
Like?
Yeah. It can be a combination of people between an advisor that's capable of doing it, that understands that cash to accrual conversion. It can be a CPA. There are tax accountants out there that do that as well.
Okay.
Yep.
And then I know, I don't want to be a huge advertisement for what you do as a feature
sure.
of this, other than we really appreciate your advice. But like you guys wouldn't do any taking up positions on the board for locking in any commodities, selling or buying, but you would do a lot of guidance on how to approach it and what is your risk tolerance. And somebody at that level would be in the books deep with you, figuring things out.
Right. With the producers that I work with, naturally, as we review those financials, as we look at the benchmark of 30 plus producers, people ask questions. What are they doing? What are they doing? What should I be doing differently? So through those conversations, we naturally get into the risk management conversation, one of the biggest conversations that we have, and what can we be doing differently? You know, who are these other producers working with? What kind of decisions are they making? How hedged is everybody right now? Mm-hmm. So all those different pieces definitely come into conversation during our monthly and quarterly meetings.
Okay. All right, Damon, thank you. I'm thinking of two take-homes I got from this today. One is your comment, discipline leads to freedom. Spoken like a true Dutchman, I think. That's good. That's just kind of something you could hang over your wall, over your desk. And the second one is just why you're here. And I'm thinking, why are you here? Why? And if I'm drilling it down and boiling it down, it's we got some good times currently and ahead of us. Don't squander it.
Yep.
You know, prepare for the times ahead of that. So be the ant instead of the grasshopper a little bit on how you think through the next several years. Yep. And discipline leading to freedom. It's truly about being disciplined as we go through these good years. Like you said, stay on that risk management, stick to that strategy or policy, and don't let losing a little bit of money on risk management deter you from doing it, because you will miss the opportunity when the market goes down. All right. Thank you, Damon. Did we cover everything? I don't know if
I think so.
We probably over-covered things.
Yeah, for sure.
Katie will edit many things out.
She can edit out. Yep.
Okay. Well, good. I appreciate you being here, and I want to say thank you to our listeners for tuning in to this episode of the SwineTime podcast here at Pipestone. The SwineTime podcast was created for the pork industry and individual pork producers around the country. Hosted by me, Dr. Spencer Wayne with Pipestone Veterinary Services, the podcast contains pork industry news, advancements in animal care, and how to enhance your productivity. Find the SwineTime podcast at www.pipestone.com or on your favorite listening platform.